Hello and welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vinny Motiwala. Down morning, right? So far, benchmark indices are down close to about 0.5%. The Nifty is holding on, clinging on to 25,900. But there is a fall of about 130 points in the Nifty. Sensex lower by close to about 450.
Hi, Reema. Good morning. So, yes, a bit of a down morning. Those midweek blues are coming in for the markets, maybe in the form of red. But, yes, that's what we're keeping an eye out on. Today, when you look at it in terms of all the sectors, they are also trading in the red, except PSU Bank, that's flip-flopping between the red and the green. Look at the Nifty down 0.5%. Look at the mid and small cap. That's also seeing a decline in today's trading session as well. And PSU Bank, like I was mentioning, flip-flopping in the red and the green. Mid cap down 0.2%. So that's something to watch out for. Small cap, that's also seeing a decline of almost 0.2% as well. Apart from that, IT Bank, that's not lending any sort of a support. Nifty Bank is down 0.3%. Nifty IT is down 0.6%. And the top sectoral loser today, obviously, is the pharma pack. We're seeing pressure coming in for Dr. Reddy's. So clearly, that's the one that we'll be keeping an eye out on as well. Today, as of now, when you're looking at it, the Nifty is not managing to hold on to the 26,000 mark. 25,900 is where maybe the support is coming in. But let's move on. And SEBI has proposed those major changes or overhaul of India's mutual fund fee structure to simplify charges, boost transparency and reduce that investor cost. Now, what are the details of this? What will it mean for investors specifically? We have Deepak Shenoy, founder of Capital Mind, joining us now to talk to us about that as well as the markets. Deepak, good morning. Thank you so much for joining us on the show as always. But let's start with the changes that have come in, right? Now, what are the key highlights maybe that one could see? We know those reduction in terms of expense ratio that's come in. That's a positive. But any other key highlights that an investor maybe is missing out when they invest, if these changes actually come into play, that would be beneficial for them?
Oh, I think overall, first we'll have to just say two things. This is a draft regulation, so there's a lot of discussion that is going to happen before it actually comes through. So we can't assume it will. So I'm making these statements on the quality of the recommendations rather than that it's final. Secondly, we are a AMC, so therefore have a bias and inherent interest in this. One of the things that's happened is some of the regulatory elements, and a large part of them are actually not concerning the investor. They're actually concerning the operations of the mutual fund, which have been, in that sense, deregulated. A lot of old elements have been removed. Frequency of certain meetings have been reduced and so on. This reduces compliance cost at the AMC level to a certain extent. There is also two proposals I think that have been most recently discussed. One is there is a lower TER mentioned. They've discussed this earlier as well. And this time what they've done is they've done away with one thing, which was a 5 basis point fee that a mutual fund could charge if it charges an exit load. This was for the past. When earlier exit loads used to go to the AMC. Then they said the exit load cannot go to the AMC. The exit load has to go to the fund. To compensate for the loss of income for a few years, they allowed the AMC to charge an extra 5 basis points for having if they had an exit load. So this is now not there in these draft regulations, or has been removed from the draft regulations. So that cuts certain income levels of funds which charge this extra 0.05%. And the second one is that they have said overall fees come down, but it actually is not coming down in the sense that currently GST is within this current limits, and the limits are actually slabbed. So 2.25% at the highest for up to 500 crores. Then for subsequent 250 crores, you can charge only 2% or something. So your blended fee comes down to like 2.16 and then 1.9 and so on. They have reduced this entire thing by 15 basis points. Now, you might say that this is a reduction of everybody has to reduce their fees, but actually they've taken the GST part of what was inside this 2.5% to say, no, let's keep the GST outside of this. And the remaining fees should be within this new lower limit. If you consider just the math, let us say this is a fund that charges 0.9% as management fees and I think it'll be 1.35% if you assume the full 2.25% is taken, or say 1 and 1.25%. And that 1.25% included GST, right? The 1% of the management fee, the GST is outside. So leave that as in that's not considered as part of the limit. The GST is not considered part of the limit, but the 1.25 includes the GST component. Now, if you remove the GST component, the GST component itself is about 18 to 19 basis points. So 0.19%. So in the sense of reducing by 0.15%, and you get a benefit of 0.19% because it goes outside the limits. So it doesn't change anything meaningfully for anybody. It's actually neutral in that sense. So there is no impact on both having to pay a lower fee to the AMC or having to pay a lower fee to anybody else, the brokerage or distributors also.
Right. Also, Deepak, what is the ask now from the industry, right? Because you are a part of this as well. So what are AMCs now asking, or what is the conversation that you all want, or maybe a change that you all want from this proposal? Is there anything specific that you all are looking at?
Yeah, so I think I can't speak for us all. I think that would be an AMFI kind of a discussion. But I think these regulations are by and large good. There is still, I think deregulation is a long process, so it takes a lot of time. There are certain things that we would like, for instance, but it's not part of SEBI's mandate, or it's the RBI, for instance, that restricts foreign investments of Indian mutual funds. So those are things that I think collectively that maybe say we desire. But by and large, I think the elements of regulation have been in the favor of both an AMC and the investor. The highly regulated nature is what makes it so much, gives so much confidence to investors to, pay out. There has been no major issue in mutual funds for a long time now. And I think the number of issues have come down substantially, and investor interests have been protected. So I think that way this regulatory piece is quite good. We'll have to see comments on individual elements. There are still, areas of operation where sometimes we have dual layers of reporting. We report the same data in different ways to the same regulator, but to different teams. So those are some of them have been taken away, but this is a good deregulatory measure. There are some proposals that SEBI had earlier mentioned with respect to target oriented plans, where you might actually say, I want to retire in 2045. So give me one plan I can keep putting money into. And that plan will initially have high equity exposure. But as I come closer to my retirement date, or let's not call it retirement, just target date, I will say that I will want to go lower and lower in equity and higher and higher in debt. A fund that automatically does this. SEBI had a proposal for this. I hope that sees the light of day as well.
Deepak, hi, Rima here. Just markets today, of course, are down. Are you getting a sense that we are facing a lot of resistance to get back to the higher levels? Overall, how are you seeing the markets right now? And then throw in a quick word about Lenskart and the valuations. Would you recommend subscribing? And the new one is Grow. They've come out with a market cap of 61,000 crore. It's a great platform. It's growing very well. But then there is that elephant in the room about potential phasing out of weekly expiries, which changes the numbers completely. It's a game changer if it comes through. So give us your view on these two.
Quickly, I may not be able to comment on individual stocks. I'll give you the overall summary on general of IPOs that have a large amount of VC funding in them. Typically, the venture capital companies want to exit the stock after it gets listed. This creates downward pressure on it. And typically, you see these stocks reach points where there will be, a large amount of sales coming through. And those you've seen this in the last 4 or 5 years. A lot of these stocks see a much lower price 6 or 8 months after the IPO than earlier. So I would say, there's no hurry to rush in and lock in your entry price or something like that, especially in a euphoric scenario. And it's always useful to wait for at least 1 or 2 quarters of results to see whether in general, in any IPO, the results were dressed up only for the IPO. And I would say this not just for these companies that you mentioned, but in general, I would say this is the, always wait till you can see the performance after the list before you make large commitments. I think those are general sequences. We have. At least at this point, no comments on individual stocks. But in general, the brokerage sector also is going through a down cycle because of the reduction in expiries, I think, in general. And I'm saying we're seeing also a reduction in the customer counts in some of these, the top 2 or maybe top 5. Out of the top 5, the top 4 have seen roughly a 10% cut in their active clients as of September 2025 compared to March 2025. So the number of actively trading subscribers have also come down. So you have to be cognizant that the past growth may not necessarily reflect as easily into the future. So these are the two things. What was the second question? I thought I completely forgot. Oh, the market. Yes. So I don't see the market this is a good thing when the market tries to break through its past high and then, has a lot of, it is what is called a resistance in the technical language of things, but it's a simple behavioral thing. Somebody who bought last year at the time when the Nifty was 26,000 is probably one of those people who's saying he saw this 20% downturn, is probably thinking, when it comes back to my buy price, I will sell. That is what causes a last high to be a considerable resistance, because lots of selling comes in roughly around that time. You're going to see this happen over some time until the consolidation happens, and only if it breaks out beyond this into relatively into newer highs is when you are going to actually see a trend up. I think it's a good thing because we're coming there, but I don't think we're there yet.
All right, Deepak, we leave the conversation here. Thank you very much for joining in. Need to get into a break. On the other side, we'll talk cryptos with Richard Green from Roots Stock Lambs on the other side.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
On Crypto Corner, we have with us today Richard Green from Roots Stock Lambs. Richard, hi, thank you so much for joining in again. First of all, talking about the month of October, which usually is a positive month across last many years, but this one doesn't seem to be turning around that way. And more importantly, there are more leveraged positions that seem to be getting liquidated. How are you reading October this time?
Yeah, absolutely. I think that there's a couple of reasons for that. You're seeing with the US FOMC meeting approaching and also the US-China tariff meeting that traders are assessing their levels, looking at whether they are risk on or risk off. And so I think it's more of a holding pattern than anything else before they start to make their decisions based off of the back of what Powell says in that meeting. And then obviously within that open interest and the futures side of things, that was a huge amount due to what occurred with Trump's announcement due to the tariffs. And what that is coming from is mainly leveraged positions. So those people who had large leverage positions being liquidated, and that's not always a bad thing within the markets. It's something where you are kind of clearing out a large amount of those that are potentially over leveraged. But what I think was very positive for Bitcoin especially was that the low that you saw after that open interest falling away and those future positions closing out was that it wasn't as low as it previously has been.
Well, Richard, October also saw some other positives like more banks onboarding crypto services like the likes of JP Morgan, Citi, BNY. How are you looking at banks now getting into the crypto space?
you're seeing the likes of Citi, Societe Generale, all of these banks and Western Union institutions coming in. And what you're usually seeing them doing is they're obviously coming in with a crypto-centric or a Web3-centric partner. So if you're looking at Anchorage Digital with Western Union, if you're looking at Citi and Coinbase, they're choosing a very well-established partner to enter the market and deploy, whether that be a stable coin, or whether that be something for their customers. And I think that what is great to see within that space is that they are entering the market. They're doing so incredibly cleverly with a partner. So they're taking a risk-on approach, and they're wanting to review not only what are we doing, what is the world of crypto about and tokens, but what is the infrastructure world about with blockchain. And that's exactly how blockchain should be looked at. It should be considered as an infrastructure layer. And how can I, as a bank or an institution, use it throughout my business, not just in a single space? So I think that you're seeing these banks and institutions going into the world of Web3 crypto with a gateway kind of product, testing the waters a little bit. And what you'll then start to see is that starting to grow into the bank as a whole, whether it be back office, middle office, payments, and those kinds of things. So again, super positive news.
Richard, just taking a step back yet again and talking about the leverage sell-off that the street has seen in this month itself, would you say spot is better to trade within ETFs, even better rather than doing leverage trade?
Yeah, I think that the market in itself has been predominantly, especially Bitcoin, has been predominantly a spot-driven market over the past, let's say, a number of months up until about April or June. And what you then started to see was that it becoming more of a futures-driven market. I think that the volume, looking at like CME futures, you're starting to get an increase in volume back to previous levels that we saw. So people are re-entering with those positions, and they're doing so in a speculative way. But there's been that more of a spot-driven market when you start to look at the things like the ETFs coming into play, right? So the Bitcoin ETFs are already incredibly successful. You've seen more ETFs coming to light. Solana ETF launched this week. And so I think that is driving more of a spot market as well.
The other thing that also is doing well, Richard, is the tokenization of assets. The RWA numbers are now picking up quite strongly. 2025 has only built upon what 2024 did. Are you looking at 2026 building up on this yet again? Are you looking at growth continuing in the same pace?
Yeah, I think it's only going up. I think that if you look at you have to look at different things when you're talking about tokenization. You have to consider the infrastructure that sits behind that. And you've got significant players in this space. If you look at Securitize, they've just come out announcing that they're going to be listing via SPAC. And the infrastructure that sits under a firm like that is very TradFi relevant. It's regulated, it's compliant, and all of those things. So I think that what you will see is more and more people considering tokenization, not just as a way of distributing their funds or whatever asset it is that they're wanting to tokenize, and increasing that kind of market that they can appeal to, but also they're looking at it from the technology standpoint, 24/7 trading, fully automated tracking in terms of it all being blockchain present and things like that. So I think that where you'll continue to see more tokenization is in inefficient markets. So equities are fantastic in TradFi, lots of liquidity, lots of trading. And so that's a great place to be. But it's actually probably more the fixed income markets, the private credit markets, those kinds of areas where there is a greater opportunity for tokenization and the benefits that tokenization brings. So I think that more and more Web3 crypto and native businesses will adopt tokenization for all of those reasons mentioned. And you'll also start to see the TradFi institutions moving over, like you already have done with the likes of Franklin Templeton, Apollo, and those larger asset managers.
Richard, one final question. And as we move along from here, we have seen stable coins do quite well. But even with what the numbers that we are looking at, perhaps 99% is still US-backed stable coin. How fast do we see other countries following? And what is your sense on the Asian markets picking up on this one?
I think US dollar will always be dominant for a number of reasons, in the sense of people wanting dollars as a hedge against own currency inflation. But I think where you'll start to see more stable coins arising is within nations where there is a need for, again, the infrastructure benefits of stablecoins. So if you look at emerging markets, if you look at Latin America, Asian regions, India and those kinds of places, there could be benefits to help with the payment systems that they have. I think that if you're looking more towards the likes of the European regions and the UK, obviously where I'm based, there are still conversations around, well, what should we be bringing stable coins to the market? Well, our payment systems in Europe and the UK are pretty strong. And so the reasons for using a CBDC or for a privately created stablecoin are probably less so, but there are still very strong benefits to it. So I think that what you'll most likely see is these stable coins arising from different regions and being on-ramps into the major stable coins such as dollar. And there'll be a lot of businesses setting up alongside that to help people moving in and out of local denominated stable coins into dollar denominated stable coins and back again, making that transition as easy as possible.
Thank you, Richard Green, for joining in and talking about the whole host of things that seem to be bothering October, but look positive and it looks longer term there. But with that, we'll slip into a short break. More market talk on the other side.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back to Trading Hour on CNBC TV18. As of now, Nifty has come back towards the day's highest point. Let's keep an eye out on that. 25,960 around that mark is what the Nifty is trading at. But the big focus today and the big story for the day is Dr. Reddy's. We've seen a sharp fall coming in for the stock today, and this is after the approval of its semaglutide injection that was delayed. For more details, Ekta, Dr. Reddy's semaglutide in Canada, that's a big deal over there. So what is the latest update that we're picking up here?
Well, yes, the street was watching out for this particular approval quite closely. So what the news is that Dr. Reddy's has received a notice of non-compliance from the Canadian drug regulator for semaglutide injection, or Ozempic generic, which is basically how, it's popularly known. Now, the non-compliance notice seeks additional information and clarifications on specific aspects of the submission. The company says that they are committed to making this important therapy available to patients and other markets at the earliest. To put it into perspective, the semaglutide patent expires in 2026 in Canada. It is expected to be a competitive market. The company has indicated that themselves. They expect the semaglutide opportunity to be via partners or directly in the next 12 to 15 months in 87 countries. So they're not just banking on Canada now, but they're looking at over 80 countries. The notable countries besides Canada will include India, Brazil, as well as Turkey. And they expect that the volume of around 12 million pens that they have will be absorbed in other countries, if not Canada. So that's what Dr. Reddy's has said.
Okay. And what about the analysts? How have they assessed the impact on Dr. Reddy's?
Well, yes, for Dr. Reddy's, it will really depend on what kind of competition we're going to see in the market, and hence what the permutations and combinations would be for Dr. Reddy's. Analysts expect around 5 other filers. We already know it's likely to be a competitive market. But are they going to see the same fate as possibly Dr. Reddy's in terms of not getting approvals easily? That's something that the street will watch for. So hence the approval timeline will be closely watched. The street also expects possibly a delay of anywhere between 5 to 12 months for Dr. Reddy's in terms of getting an approval. So whether or not they'll manage to get the approval in Jan to launch by Feb, it all depends on whether the Canadian regulator is okay with the kind of submissions that they make on whatever issues that they've had. And FY27, the street is built in around $100 million in terms of revenue from this opportunity. So let's see whether that does come through. Nomura has a buy, but they've cut the target price to 15.80. They've lowered the FY26 to 28 EPS by 3 to 6%. Morgan Stanley equal weight target price 13.89. The success in Canada and semaglutide will be a key driver according to them in FY27. Citi has a sell with a target price of 9.90. Revlimid has led the Revlimid-led drag according to them may be tough to offset because Dr. Reddy's has faced some amount of negative news in the past couple of days with regards to its complex drug pipeline.
Ekta, what does it also mean for Shelley Engineering? That stock is also under pressure today.
Well, yes, Shelley Engineering, if you look at that stock, it's down around 12%. Now, the reason for Shelley Engineering to be in focus is because they provide pens. They produce pens. They work in the pharmaceutical industry. So they produce pens which are then used to sort of give that subcute injection, which is either Ozempic or, other injections with other drugs. So they are in focus because they produce these pens for all of these pharmaceutical companies, including those who are manufacturing GLP-1 drugs such as semaglutide. Remember, it's going off patent in various countries in FY27 or next year onwards, and hence the opportunity for a company like Shelley Engineering would be huge if in case they do supply to other companies as well. Now, Dr. Reddy's is in focus because it's one of their key customers according to analysts, and that's the reason why you're seeing the stock lower. And if you look at their Q1 numbers, the revenue was up around 181% to 77 crores in terms of the pharma segment. Around 60% of the pens that they sold in Q1 were GLP. Now, we don't know how much of it was Dr. Reddy's, but we do know that a large part of their revenues is actually coming in from this opportunity. So one will have to wait and watch and see what the impact could be. But remember that the opportunity for GLP would be spread across. It won't just be limited to the Canadian market for a company that is supplying pens. Everybody will need the pens wherever they, use the drug, unless eventually you start using the oral drug, which will be the next big trigger.
Indeed, thank you very much for explaining it. For now, we will slip into a very short break. We'll come back with more on the market. Stay tuned. Welcome back. The big performers and gainers this week are the refining stocks. MRPL, Chennai Petro up for another day in a row. And this week, MRPL is up 15%. Chennai Petro has gained 12.5%. And even the oil marketing companies like HPCL, BPCL continue to move up. They've soared about 8-9% so far this week. So keep your eye out on oil and gas. But it's time now to talk about futures and options. Mangalam joins in from the F&O desk.
Well, we're down but not out. Day 2 of November series. Day 1 was fairly good. We closed above that 26,000 mark. And today it's just a bit of that give back which is taking place. Why do I say that? Because, Nifty is a wee bit under pressure. The mid-cap index is actually outperforming by not falling as much. And the Nifty Bank, which did not gain as much yesterday, is not giving back as much today as well. Down about 1/3%. So large part of the gains that came by yesterday were not from the Nifty bank, and today as well, a large part of the losses are not from the Nifty bank as well. Nothing really to worry about. Why do I also say that? Is because had there been some worry, then the India VIX would have seen a big spike as well. That's not the case. The India VIX is just marginally higher, hovering around that 12.3, 12.4 mark too. And as that happens, the street believes that the range will continue. Today as well, the low on the Nifty was closer to that 25,900 mark. So 25,900 to 25,300 is the broad range that the street is working with. In fact, the 26,000 call, once we cross past yesterday and the earlier high of 26,100, is only then can we look at fresher highs on the Nifty. But as of now, the call writers believe that maybe around 26,100, 26,115, there could be some supply that would come by, which is why they're writing those calls. At the lower levels, however, 25,900 put is fairly active. So you're looking at that range to be sustained between 25,900 to 26,100 thereabouts. So fresh longs added on IIFL Finance. And if you look at, CAMS, there was a serious amount of short covering is what is going on underway in CAMS right now. So I'm watching out for these two stocks.
Okay, Mangalam, thank you so much for that. But let's also bring on board Jay Thakkar of ICICI Securities, who's joining us to give us a quick check on the market, on the technicals. Jay, good morning. Thank you so much for joining us. In terms of levels, you're keeping an eye out for Nifty as well as Bank Nifty, as well as your individual picks.
Good morning to you, Vinny and Rima. Well, as far as the Nifty is concerned, I would say that that's been trading within that range of 26,100. I mean, since past couple of days, we have seen that it made attempt to surpass 26,000 and close above those levels, but then it's not able to sustain above those levels. In fact, it closed above those levels in yesterday's trading session, but then today again, unfortunately, we are seeing it again, it dipping below 26,000 levels. So I think that, in the short term, we need 25,700 to 26,100. That is going to be the range for the index. And I believe that once this consolidation is over, the probability of a breakout on the upside is quite likely. Post this consolidation, Nifty is likely to make a new high, is what we believe. And sectorally, there is only one sector which we think as of now there is a lot of pressure. That is Nifty IT, wherein we still have a lot of shorts. And hopefully, if at all we see some short covering there, then it could help Nifty to inch higher. Stock specifically, I would say that I have two buy recommendations. The first one is on what Rima initially was talking about, the oil marketing companies. So yes, HPCL looks great on the charts, as well as the derivatives data is quite positive out there. So HPCL trading around the levels of 475, 76. I think one can buy this with a stop loss of 460, targeting 510 to 525 in the near term. And the second buy recommendation, really would be on Shriram Finance. That's from the financials. It has taken off its multiple swing resistances, and we have seen a great, good long build-up here as well. On the downside, 720 now is a very crucial or critical support from Shriram Finance. With a stop loss of 720, one can buy this, targeting around 800 on the upside. And a final buy recommendation would be on United Spirits. We are expecting a good short covering out there. As a disclaimer, we have recommended that to our clients as well. And I think United Spirit is likely to inch towards the levels of 1,460 to 1,500 going forward. Once the call base of 1,400 takes off, I think there will be further unwinding on the call side, as well as short covering happening there. On the downside, we believe that 1,350 is a good short-term support. So with that, we'll go along on United Spirits as well.
Thank you very much for that. So Shriram Finance and United Spirits. If you look at the Nifty gainer stocks bucking the trend, right on top is Coal India, but that's rebounding after a subdued performance yesterday where the stock declined post Q2. And the other one is L&T, reacting to their numbers, where we had a good set, top line growth of close to about 10.5%, and EBITDA jump of 7%. Vivek joins in with the details.
Well, that's right. So L&T, one of the stocks that are doing quite well in the session. Capital goods, infra major, a lot of developments, a lot of key read-throughs, especially as far as the commentary from the management, both in the media as well as the analyst call is concerned. While we're talking about the core P&L was a slight miss to our estimates across all of the parameters. EBITDA margin largely in line with what we were anticipating. What led to the top line miss? Monsoons across the country led to delayed execution. So that impacted execution on the top line, and margins were impacted by execution completion of older legacy projects, while the new projects are yet to reach levels where revenue recognition and margin recognition can be done. So both top line as well as margin, the miss has been accounted for or has been given clarity as far as the management is concerned. Now, what are the key triggers we watch out for? The core E&C margin. So that came in at 7.8%, 20 basis points uptick. The order book very strong at 6.7 trillion rupees. Order prospect pipeline very, very strong at 10 trillion rupees. That's one of the key takeaways. And the thing that the management told us was that they are seeing a revival as far as domestic private capex is concerned, something that the industry and all of the capital goods stocks companies have been waiting for a very, very long time. Now let's do a quick guidance check, again for the management had indicated at the start of the year and where they stand at the end of H1. Top line growth, the management had indicated 15% uptick. They are now at H1, they are at 13%. Management said they're on track to meet the guidance. Order inflow guidance of 10%. While they did not specifically go ahead and change or upgrade the guidance, they said that they are very well placed to exceed the guidance of 10% order inflow that they are given at the start of the year. And looking at the L1 position, it appears that they should be able to do so quite easily. And core margins, they are given a guidance of 8.5%. They currently are tracking around 7.7 to 7.8. It's still a work in progress as what the management has indicated.
Okay, thank you so much for that, Vivek. L&T as of now up almost 1%. But a quick note for our viewers, if you did like to access expert-driven insights and actionable chart patterns, simply scan the QR code on your screens and subscribe to the Money Control Super Pro and get daily expert calls, actionable charts and insights to power your investing decision. Plus, the festive season, there's more to reason to celebrate. 10 lucky subscribers every day win 1 gram of gold. So do not wait, scan, subscribe and make your portfolio shine brighter with Super Pro. Welcome back to Trading Hour on CNBC-TV18. Now let's move on and get to what were the updates that came in from Trump as well as Xi Jinping's meeting. Now, in a historic high-stake meeting, US President Donald Trump, who met with Chinese President Xi Jinping in what was his first in-person meeting since 2019, a whole host of trade-related issues were discussed. CNBC's Sherry Kang is joining in with us to give us the details.
U.S. President Donald Trump called this 1 hour and 40-minute long meeting with his Chinese counterpart Xi Jinping amazing, touting a lot of progress that has been made. For starters, tariffs on China coming down from 57% to 47%. When it comes to some of the sensitive topics like rare earths, and this is actually where China has a lot of leverage over the U.S., Trump says all rare earth related issues have been resolved. He also added that soybean purchases will start immediately, and fentanyl-related tariffs are coming down from 20% to 10%. So what now? The U.S. side says this is a one-year agreement that will likely be extended. President Trump also talked about visiting China in April next year and also floated the possibility of his Chinese counterpart Xi Jinping reciprocating that after that. There was no joint agreement or announcement that is also confirmed by the Chinese side. In the meantime, the U.S. leader is finishing the Asia trip and he is returning home, while Chinese President Xi Jinping is sticking around in South Korea to attend the APEC Leaders Summit and also do some bilateral meetings.
On that note, get into a break. More on the market. Stay tuned. Welcome back. Talking about numbers today, ITC should be on your radar. Manglam joins in with the key expectations.
Well, for ITC this time around, the expectations are pretty simple. Around 5 to 6% sort of cigarette volume growth, led by 6 to 7% cigarette revenue growth. The FMCG business grows at around 4%, But more importantly, we are looking at some sort of contraction in FMCG margins. And at the same time, if you look at the other parts of the business, which is the paperboards and agri, paperboards 4 to 5% sort of growth, and agri revenue likely to grow by about 10 to 15% with a mild moderation in margins, and that's largely on account of leaf tobacco prices coming off highs. What does all of that mean in terms of numbers? Do not look at them year on year, because remember the same time last year we had the hotels business in the base. So instead of looking at the comparable year on year, an absolute is extremely important. So we'll watch out for a little over 19,000 crores in terms of their overall revenue. And at the same time, if you look at the other parameters as well, margins are likely to be more or less maintained. 19,222 crores revenue, 6,300 crores of EBITDA, and the net profit a little over 4,000 crores as well. So that's a bunch of immediate numbers that we're looking at. 5,062 crores of the net profit. But then again, remember, these are not comparable year on year. You look at the absolute numbers, and that is when you make a judgment. The FMCG EBIT margins are likely to be lower on account of not only higher inflation, but also disruption related to GST. So some of those old stocks that they may be looking to end is something that we will be watching out for. Cigarette volumes. Now, BST Industries so far has reported the numbers. 10% volume growth is what they've reported. So ITC likely to do about 5 to 6%.
Okay, thank you so much for that, Mangalam. We'll keep an eye out on ITC, but Cipla is also going to be reporting its numbers today. Ekta is joining in with us with the key expectations. Ekta?
Well, yes, for Cipla this time, it is going to be out during market hours. So the revenue is expected to grow around 5% The EBITDA is expected to be flat with margins of around 25.5%, which compares to around 26.7% year on year, and a profit growth of around 3%. Now, you are expecting a decline in the US sales or sluggish US sales simply because there is higher competition for Revlimid generic and limited approvals in the US. Watch for a pickup in the oncology drugs, which are in the complex oncology generic space, which launched in Q1 and are expected to show some amount of momentum in Q2. So the range for the US estimates is quite wide. It's anywhere between $209 million to around $237 million. This compares to $226 million in the previous quarter. Now, in terms of the domestic market, expect high single-digit growth, anywhere between 7 to 9%. Watch for the impact of GST changes on the domestic formulations. Now, margin range is anywhere between 25 to 26%. And separately, the commentary with regards to FY26 guidance, price erosion in the US, in Revlimid generic, and the Indore facility re-inspection would be a couple of things to watch for.
Thank you very much for that. And that brings us to a close in this edition of Trading Hour. Thank you very much for watching.